Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Kenny Polcari. Kenny is the managing partner of Kace Capital Advisors and has been a stock trading vet for over 40 years. Kenny got his start in the industry all the way back in 1980 on the floor of the New York Stock Exchange. He continued with the New York Stock Exchange and was a member for about 20 years and has seen it all over the years. He was on the floor of the exchange during the Black Monday crash all the way back in 1987. He was on the floor of the exchange during the World Trade Center attack in 2001. He was around in 2007. He has a whole lot of history and insights to share with us on the show today. The substance of our discussion mostly revolves around market structure. Today, I think we kind of take it for granted when we deposit money into our retirement accounts or our investment accounts and we go buy a broad-based index fund or a target date fund, and that gets invested automatically in thousands and thousands of securities across the world. Kenny paints the picture of what stock trading was like back in the 80s when that stuff just flat didn't exist, and shares of stocks traded on fixed commissions until the late 70s, and then they traded in increments of 1/8 of a dollar for a long time until everything was decimalized back after the turn of the century. So Kenny takes us through the life of a stock trader on the New York Stock Exchange throughout his career and paints a really, really interesting picture of what life was like versus what markets look like today. This is one of my favorite interviews that we've had on the podcast, on the show to date. Kenny's a bombastic guy. He's really fun to talk to. He's on TV all the time. And I really got a lot out of the discussion, and I hope you enjoy it as much as I did. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Kenny, welcome to the podcast, my friend. Thanks for being on with me.
Thank you. It's my pleasure. Thanks for having me.
You have quite the prolific media career, my friend. You're on TV all the time.
Yeah. That's been a process, right? Started right after 9/11, and kind of grew from there. But look, I enjoy it because I love talking about the markets, and I think it's real important that people understand, from a layman perspective. I'm not one of these guys that gets up there and talks like trying to impress somebody. I just say it the way it is, right? From my experience after spending 40 years at the New York Stock Exchange on the institutional side and having a very specific perspective of the markets and what investors and retail needs to hear.
Yeah, and then you made my next point for me, is that you've got a lot of interesting stuff to say because of all the experience you have, and I am fascinated about what life was like in the industry in the 80s on the New York Stock Exchange. I was an old institutional guy, trading desk guy before I was doing this, and I'm really curious what it was like when you started on the New York Stock Exchange in the 80s. Can you paint a picture for us of what that means and what you were doing?
I certainly can. So had you ever been to the New York Stock Exchange? Have you ever been?
I have not been, no.
Okay. So what I think is really important, because I had the opportunity to spend 40 years at the New York Stock Exchange as a member, as somebody who had a business. I had a couple of businesses there. I ran the floor for, Salomon Brothers, which was one of the biggest institutional brokerages in the country at the time. It has since gotten taken over by Citibank. It was Smith Barney at the time. But so my perspective is very interesting. But I'll start it this way. I was 19 years old in 1980, and I was a freshman year in college, and I had the opportunity to go spend a summer in New York as an intern on the New York Stock Exchange. Now, I'm not a kid from New York. I was born in Boston, brought up in Boston, spent my summers on Cape Cod, and I had no idea what the New York Stock Exchange was. I didn't know a stock from a bond, a buy from a sell, an eighth from a quarter, knew nothing about it.
How did you get the opportunity, if you don't mind me interjecting?
Because my dad was in this. He was a broker, was a retail broker when he first got out of college, and then became a specialist on the trading floor in Boston as a member of the Boston Stock Exchange. And then he was partnered up and started a business with a group in New York. And so the summer after my freshman year, he said to me, there's an opportunity. If you want to go to work on the New York Stock Exchange as an intern, you could certainly do that, if you'd like the opportunity. So my first reaction to that was no, because I'd never been to New York City. Why would I want to go to New York City in the middle of the summer when I spent every summer as a kid on Cape Cod, right? And the summer after my freshman year, I thought, well, I'm going to go back to the Cape and be a lifeguard on the beach and have the greatest summer of my life. And so what was very interesting was over Christmas of that year, so it was 79 into 80, we went to New York because my father's business partner was throwing this big Christmas party, blah, 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 wanted to go. So he said, let's go. I want you to come meet some of these people, and then you can decide what you want to do. I said, okay, great. So we went, and I met some of the most amazing people. Amazing in the sense that they were street guys, right? They were kids off the street in Brooklyn and Queens and Staten Island and Manhattan and the Bronx, and they were street smart, but they either worked at the exchange or they were working in this business. They were members of the exchange. They were type A personalities. They were entertaining. They were funny, but they were really, really great personalities. People I had never met before in my life, right? And after I met them, we're at this Christmas party. I started talking to a couple of guys, blah, 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 and telling me about the opportunity and what it's like. And I thought to myself, okay, let me try it. So I spent the summer 1980, is after my freshman year. I moved to New York. I moved right downtown to Wall Street, which at the time, there wasn't a lot going on Wall Street in terms of residential. It was all banks and brokers. And by 5 o'clock at night, the place was cleared out because no one lived downtown. But I got a cheap apartment downtown. I was, 3 blocks away from the exchange. And so I did that. And I walked on the floor of the exchange on, May 10th or 11th or whatever it was that year, not understanding or knowing a thing about it. And the moment I stepped on the floor, I was just like this wide-eyed young kid, because the commotion and the energy in the room and the sound and it just caught me and bit me in the backside. I was like, because look, I'm a type A personality. So, and there was 5,500 type A personalities in the place. And so you can imagine what it was like. Because look, that was when stocks traded face-to-face. It was an open outcry market. There were people in the crowds. It was exciting. They traded by symbols. They traded by fractions. It was all very, very, it was a new language. It was very exciting. And I went there and I thought to myself, okay, I could like this. And so I spent that first summer there. And it was probably because I went there in mid-May. Now, again, it's like someone picks you up and puts you over in Asia. It's a completely different language. You have no idea what people are talking about. You don't understand the language. You don't understand the symbols and the fractions and why they say it the way they do. Because if you're a buyer, you spoke one way. If you're a seller, you spoke another way. You had to know symbols. You had to know what, if somebody said to you, I need to buy 100,000 burgers, you had to know what they meant. 100,000 burgers doesn't mean go out to the local restaurant, go buy 100,000 burgers. It means they want to buy 100,000 shares of McDonald's. But you had to know that because everything had a short name or they had a symbol. They said, I need to sell RTN. Well, you had to know what RTN was because RTN was different from RPN, right? And because people spoke very fast, you had to make sure you understood. So if somebody said to you RTN, you would say Raytheon because that's how you would confirm what you wanted to do. But I didn't know any of that because I didn't know the symbols. I didn't know the names. I knew nothing.
You just saw commotion and a lot of emotion, and it was attractive to you.
Yeah. It was the most unbelievable thing. So it took me like midsummer, and then I started to really get into it. I started to really understand the language, and anyway, I had a great summer.
What did they have you doing specifically? Because
I was like, you were an intern, so I was a runner.
To go buy 100,000 shares of burgers.
No. Only the brokers, the members were doing that.
Yeah.
As an intern, as a runner, what was I doing? I was going to get coffee. I was going to get lunch. I was writing reports. So after the broker went out and bought 10,000 shares of Coca-Cola, you'd have to write the physical report. You know, you had to write it on a buy pad or a sell pad, and then you had to actually deliver the report over to the woman who's going to enter it into the system so that the trade could get cleared, right? So as an intern that summer, I did nothing but go for coffee, go for lunch, and write reports and deliver them. Because listen, you had to, I knew nothing about anything. So you have to start from somewhere. So you start at the bottom, right?
Yeah.
Which is perfectly okay with me because I wanted to learn, right? So I was anxious, I was hungry, and so I did all that. I went back in the summer of 81. I did the same thing, except I got more comfortable with it. I got to meet more people. I went back in the summer of 82. Now, here's what's interesting that people should know. In the summer of 1982, Ronald Reagan was now president, had been president for a year or so. We had just come out of the Jimmy Carter presidency, right, in the 79 and 80. Reagan became president in 81. The country was completely demoralized from Jimmy Carter, right? We had the Iranian hostage crisis. We had the oil embargo. We had skyrocketing inflation. We had skyrocketing oil prices. We had all this shit. And so in the summer of 1982, that's when the economy was at its worst. That's when inflation was running at 13.5%, and unemployment was running at 10%, and guys were getting thrown out, and the economy was just going down the drain. And the Dow Jones was trading at 792. Today it's trading at 34,000. Then it was trading at 792. The average move in the Dow would have been 25 cents. You know, it was up a quarter. It was down 3/8 on the day. On the day. You know, today we're up 100 points, we're down 500 points, we're up 1,000 points, and then we close up 60, right? Mm-hmm. We used to trade, in 1981, you were trading 30 million shares a day. A day. Today, we'll trade 30 million shares in about a minute and a half, right? Because we'll end up trading 12 billion shares by the time the day is over, all as a result of the technology. But one or the other, I came back in the summer of 1982 when the country was at its worst in terms of the economy. And the guy that I had worked for in 80 and 81 was on the verge of going out of business just because it was so bad, right? And here's the other thing, the reason it was so bad. Paul Volcker was Fed chair. And in order for Paul Volcker to tame inflation, which was running at 13.5%, he had to do what? He had to jam interest rates above the rate of inflation in order to kill it. Kind of very much the conversation we're having today, so we can get into that. So Paul Volcker jammed rates up to 21.5% in the summer of 1982. It was really 1981. He pushed them up to 21.5% going into the summer of 82. So if you were think about this for a minute. If you were anyone who had any money at all, you could take your money and go to the bank and give it to the banker, and he's going to put it in a CD, and you are going to earn 21% on your money, guaranteed, sleep at night, no risk, not going up, not going down. All you know is you're going to earn 21%. So if you give the guy $100,000, you're going to have $121,000 guaranteed by the end of next year, by the end of the year, right? Because that's what you were guaranteed. So if you had any money, why would you go out and buy Johnson & Johnson and GE or Bank of America? They're fine American companies, but they are full of risk. So in an environment where the economic environment was lousy in 1982 in this country, you could go to put your money in the bank and be guaranteed 21%. You'd be foolish to do anything other than that with your money. And so all this money was in the banks. And so the guy that I was working for wasn't doing any business because people weren't buying and selling stocks. Mm-hmm. And so I came back and the poor guy said to me, I can't even afford to have you. He said, and listen, I was making $125 a week. And he said, so I was making, what was I making? $500 a month. And it was just an expense that this guy couldn't have. So he said to me, I can't have you back. I said, okay, no problem. So, but I had known, now I'd spent 2 summers there, so I'd known a bunch of people. Mm-hmm. So I said, okay, before I decide to move back to Boston and go, maybe this is the summer I'm going to work on the beach, let me go around and see some of the brokers and all that stuff. So I went around to see some of the brokers. Now, what was interesting was I came to this broker that I had known, and his business was very different. He was very busy because he was doing this option layoff business, which was this new options with this new thing. And they connected the options market in Chicago to the New York Stock Exchange and the stock market in New York. And these guys would take options positions and have to offset them with stock positions. And so it was very busy. Meanwhile, the first guy wasn't doing that business, which is why it was a different model, right? So this guy, I go over to him. Oh, he welcomes me back. He puts his arm around me. So great to see you. How's everything? Blah, blah, blah. I said, it's great. Other than Doug can't have me this year. Doug was the other broker. He goes, what do you mean Doug can't have you? I said, well, he's not doing very well. And he's, his business is doing very well. And he can't afford to have me. So he looks at me and he puts his arm around me. He said, really? He said, let me ask you a question, kid. He goes, do you know the difference between a buy and a sell? I go, yeah. He goes, do you know the symbol for IBM? I go, yes, it's IBM. He goes, you know the difference between an eighth and a quarter? I go, yeah, 12 and a half cents. He goes, how's $2.50 a week? $2.50 a week? I just got a raise, and I was so excited. And so I went to work for that guy, who I then became. I went back to school my senior year. I graduated in 83, and I came back to work for that guy in 1983, became a junior partner in his firm until he retired in 1992, and then the rest from there is history. But one way or the other, when I was working there, it was all very human-based. It was open outcry, pen to paper. You take down, the phone would ring. You'd write an order, buy 100,000 XYZ, sell 50,000 Coca-Cola, buy 20,000 Abbott Laboratories, whatever it was. And you'd have to give it to the broker. The broker would go out to a trading crowd. He'd go to where Abbott trades, or Coca-Cola, or Johnson & Johnson, whatever it was. And he'd have to assess what was going on in the crowd. He'd have to make a decision based on what his client wanted to do. He'd have to understand what the other guys in the crowd were doing, and then execute that order. But it was all very exciting because it was all human-based, and there was lots of conversation, and every day was different because every day the news was different, right? Could have been news today that affected Johnson & Johnson. There could be news tomorrow that affects, I don't know, the auto names, whatever it was. But it was all very, very exciting. And because there were 5,500 type A personalities there, it was even more exciting for me because, type A's feed on each other, right? It's like a drug. Their excitement just gets everybody excited, right? And so that's what it was like. And I would wake up every morning, click on my heels. I couldn't wait to get there because it was so exciting to be there, and the energy in the room and the excitement and being right there to think of it. But what really happened in the summer of 82, I just said to you, the country was in a complete disaster. Interest rates were 21%, inflation was 13.5%, and unemployment was 10%, was that on August 16th, which was a Monday, there was rumor out that the Fed was going to come out on Tuesday morning and make this surprise announcement. Well, here's the thing about the Fed. The Fed never made surprise announcements. The Fed would usually come out on Thursday mornings. They'd come out from behind the door, step up to the podium. They'd make an announcement. They'd close the folder and then go back. They didn't stop and ask you, are you okay? Do you need a Xanax? Come and lie down. Let's talk about this. Let's make sure everyone's good. They didn't do any of that shit. They came out. They said, here's what the Fed is doing. We're either raising rates, lowering rates, doing nothing. And then they walked away. The market had to figure it out, right? So on this Monday, there was a rumor that the Fed was going to come on Tuesday when we make this announcement. Now, remember, there's no internet. There's no Twitter, LinkedIn. There's no Facebook. There's none of that. There's no television on the floor of the New York Stock Exchange. There's no radio on the floor of the New York Stock Exchange. The only way when you were standing on the New York Stock Exchange that you got any information about the outside world was when the phone rang and somebody told you. Either that or you read the newspaper, right? But when you were on the floor of the exchange during the day, there was no outside contact. And there was a method to that madness, because when you were in a trading crowd representing an institution at the point of sale, you as the broker were supposed to react to what was happening in that crowd at the moment, supply and demand at that moment. You weren't supposed to be poisoned with word about what was happening out in the world, right? You were supposed to just react to supply and demand. So
because if you're an institution, you don't want the broker executing trades for you going off on their own.
Right.
The direction of one of these issues.
The broker needed to focus on what was happening in the crowd, right, on your behalf. Right. So on this Tuesday morning, I come to work, and the place would start to fill up at 8:00, and people would start being there and organizing their books and organizing the work from yesterday and getting ready for the day. And as 8:30 approached, the room got quiet. It didn't get quiet, but there was, the kind of hush went down because people were curious. Was the Fed going to come out and say anything? Weren't they going to say anything? And how would we know even if they did? You're only going to find out was when the phone rang and somebody told you whether they did or they didn't. So it was about 8:30 and 30 seconds, and every friggin' phone on the floor lit up. Every phone, all at the same time. Because, in fact, the Fed did come out. Now, Paul Volcker was Fed chair. And he did come out on that Tuesday morning, and he made this announcement how about he was going to break the back of inflation, which he had already done by raising rates up at 21%. And he was going to reinvigorate the economy by cutting interest rates, right? Now, when you cut interest rates, what happens? Money comes out of the bank and it goes into the markets, right? Which is exactly what happened during the great financial crisis. When they cut rates to zero, the market took off because you weren't earning any money in the bank, so you took your money out of your bank and you invested in stocks, right? And so that same theme in 1982 is exactly what he did. So he came out, he made this major announcement that he was cutting rates by 10%. Now think about that for a minute. Interest rates are 21%, so 10% was 2 percentage points. It was a massive move. Today they're talking about raising rates by 0.5%, and everyone's having a nervous breakdown. Then he announced that he was cutting rates by 10% and that rates were headed lower in order to reinvigorate the economy. And that was the birth of the greatest bull market this country's ever known. And I say that because I was now 20 years old and I'm standing there in the booth and this announcement comes out and suddenly the place got overwhelmed, right? With buy orders. Everything was buy 100,000, buy 50,000, buy 300,000. Everything was buy. And the market that day, now Monday we traded 30 million shares and maybe the market was up, 50 cents, half a buck. Tuesday, when the announcement came out, we traded 138 million shares, so 4 times the volume. And the market was up 4.5%, which was the equivalent of 35 points. Was a massive move, right? But it was the beginning. It was the birth of the greatest bull market this country's ever known. And I got to tell you something. As I sit here and I tell you that story, I can feel myself. I remember what it was like to stand on the floor, stand in the booth at that moment when that came out. I can hear the phones ringing. I can hear the people screaming. I can see myself taking these orders and working with the program. It was amazing. It was amazing. So I went back to college my senior year in summer of 82, in September of 82. The guy offered me a job upon graduation in May of 83. So here's another great thing you have to think about. Kids couldn't get a job in 1982 because the economy was still a disaster, right? This guy offers me a job upon graduation 9 months out. So I was going back into my senior year. I had this job in New York on the New York Stock Exchange that I absolutely loved. So I went back to senior year and had the greatest time of my life because here I had this job. I was set. This guy was going to pay me $32,000 a year. I hit the friggin' lottery in 1983, right? So I went back. I had the greatest senior year of my life. I graduated. I moved back in July of 1983 for what I thought was really going to be just a couple of years. I thought because look, I'm from Boston. I'm the middle of 5 kids from a Boston Italian family. My whole family lived up in Boston. So I thought I was going to go to New York, I'll get some experience, and then I'll transfer back to Boston and work for a broker up in Boston. That was kind of what I thought was going to happen in my head. Well, in fact, that's not what happened. I came to work. It was the middle of this bull market. I met my wife on the floor of the New York Stock Exchange, who herself was also a member at a time when women were just pushing through the glass ceiling. They were just becoming members of the New York Stock Exchange. My wife, I think, was the 9th female member of the New York Stock Exchange and the first minority. My wife is Puerto Rican, so she was not only a woman, but then she was a minority. So she was the first Latina member, female member. And at the time, I think there were 1,366 members total. And at the time, there were 9 or 10 female members.
Can you explain to everybody what it means specifically to be a member? What does that enable you to do?
So the member is the person, the man or the woman who actually buys and sells the stock, right? So if you're not a member, you are not physically, you were not. Today it's different. Then the member is the guy who had the badge. So if you see it, you see the guys running around with the badges on. They were the members. But they were the men and women that were charged with physically going out to the crowd and representing the client, the institution, the asset manager, the money manager, the mutual fund, the pension plan, whatever it was, at the point of sale. So the member was that person, and you had to own a seat or lease a seat, right? The seat was the membership. Mm-hmm. And at the time when I became a member in 1985, seats were trading at about $400,000. And if you bought a seat, you had to pay for it cash. You couldn't mortgage it like a house. You had to pay for the seat cash. Now, I was 24 years old when I became a member. I didn't have $400,000 to buy a seat, so I leased the seat. Leases were a function of the price of the seat. So I think my first lease was $60,000 a year. So it was $5,000 a month is what I paid. Then seats, because there were a limited number of them, would trade up and down like stocks. In economic times, better economic times, they would trade higher. When the economy got tough, they would come in just like a stock would trade, right?
Yep.
And so So that's what happened. And then next thing you know, 40 years goes by, right? I got married. We have kids. I buy a house. Next thing you know, 40 years goes by. I was in New York, and I loved every single minute of it. It was so amazing. But, I was there during the birth of the greatest bull market. I was there in 1987 when the market crashed, which is a whole nother story, right? Because after 1982, when the market started taking off, over the next 5 years, the market made massive gains because interest rates went from 21% down to about 5%. And so there was this real reallocation of investable dollars. A lot of that went into stocks in the market. And so the Dow went from 792 to 2,800 by the summer of 1987. So there were massive gains in stocks and the Dow and the indexes and all that. And over the period of time, probably starting like maybe in 85, 86, there were these guys that suddenly showed up in colleges. There was this new education choice, and it was called quantitative analysis. But quantitative analysis was not, it existed, it always existed, quantitative analysis. But by this time, it became quantitative analysis using computers and technology, right? And so these guys designed what was now known, it's still known as portfolio insurance. And portfolio insurance is just that. It's an insurance product that protects you against a loss, like life insurance, health insurance, disability insurance, whatever. You buy it to be protected against a loss. Portfolio insurance was this product that was supposed to protect you as an asset manager might manage, $1 billion. And so now you buy this portfolio insurance product and you're supposed to get signals based on a computer algorithmic program back in 1986, 87, that's going to tell you how to protect your portfolio in the event that the economy started to turn sour or the macro data around the world started to get weaker. This computer was supposed to tell you what you needed to do to protect it, correct?
Mm-hmm.
So these guys created this product and they back tested it, but you can't really back test it. You can back test it, but back testing it in kind of a controlled environment versus testing it in the real world are two very different things.
Yeah.
And
If you ever hear a math guy talk about in sample versus out of sample,
yeah,
we don't care about out of sample, right? Because I guess, and keep going because I know where this is going. But
so as the summer came in 1987, the global economy started to roll over. We had these 5 great years of massive growth, but it's the cycle, right? The boom bust cycles in the markets. And but remember, there was still no internet, there was still no Facebook, Twitter, none of that shit existed, right? So as we moved into the summer of 1987 and into the fall of 1987, kind of, the U.S. economy was starting to slow, the European economy was starting to slow, Asian economy was starting to slow. But it took time for that information because it used to travel by newspaper, right? That's how the news traveled, by newspaper and telephone. And so the market started to come under some pressure in the fall of 1987, and then it would sell off a little bit. It would stabilize. It would rally. That would sell off a little bit and stabilize, rally, as it would do when the economy is slowing down, as investors kind of reprice risk. And so as we moved into October 1987, it was the third week. It was like the Wednesday, Thursday, Friday, 14th, 15th, and 16th of October. And the U.S. market started to come under real pressure on Wednesday. The market, traded, it sold down, closed on the lows. Thursday, the same thing happened. It closed down on the lows again. On Friday, markets came under even more pressure. And I think, if I remember correctly, on the Friday they closed down up like 99 or 100 points. But in 1987, for the Dow to move 100 points was a huge move, right?
Yeah, that's what, 5-8%, something like that?
Was a huge move. Yeah, 100 points on, if the Dow was trading at this time, it's trading at 2,600, right? 100 points, whatever it is. So it was, I went home on the Friday night. And now at this point, my wife was now retired because we'd got married. She got pregnant. Our daughter was just born. So now she's home with the baby. So I came home and I said to my wife, I don't know, something doesn't feel right to me. But what do I know? I was 26 years old. I had no money. So I didn't have anything to lose. And I go, but it just doesn't feel right to me. Something feels really bad. Okay, whatever. What did I know? So it was October now 17th. And it was my daughter's first Halloween, and we spent the weekend doing pumpkin picking and all that and carving the pumpkin and all that shit. And now Sunday night I go to bed. But here's what you have to understand. Sunday night in New York at 9 o'clock is Monday morning in Asia, right? Because of the way the world works and the time difference and all that. So Asia is 12 hours ahead of us.
Yeah.
So when I'm getting ready to go to bed on Sunday night, traders in Asia are just waking up. Well, what happened was these guys with the portfolio insurance, which, by the way, they sold to asset managers around the world. They didn't sell just to U.S. asset managers, right? They sold to asset managers around the world. And so over the weekend, they took all this data from the markets and they fed it into this big IBM supercomputer. And guess what? The first time the IBM supercomputer spits out an action. And the action was that in order to protect your portfolio, you needed to raise cash. And in order to raise cash, you needed to sell 2% of your portfolio, raise that cash, put it over here on the side. That's going to protect your portfolio because then when the market settled down, you're going to take that cash and reinvest it. That was the method. That was the logic behind it, right?
Except now, everybody is doing the same thing at the same time, right?
Well, ultimately, yes. But here's how it washes across the world. It starts in Asia, right? Because Asia were the first markets to open. Because again, the signal was generated over the weekend. Well, the markets in the U.S. are closed. Markets in Europe are closed over the weekend. And they're closed in Asia over the weekend. But on Monday morning in Asia, markets are getting ready to open. So anybody in Asia that bought this product got a message. You need to raise 2%. You need to sell 2% of your assets and raise that money and put it aside. So now I'm sound asleep because I go to bed at 9 o'clock. I'm sleeping. The Asian markets are starting to come a little bit unglued. They didn't come completely unglued because 2% wasn't like this massive, massive number. But it was enough to put pressure on the markets, but it wasn't a massive number. But what these portfolio guys realized now was that as Asian markets came under pressure, the data changed, right? Because now there's all these different price points. And the macro data in Asia, now it's a new day, there's new macro data. So these guys took the latest macro data out of Asia along with price points, fed it back into the supercomputer. So as Asia trading closes and Europe is getting ready to open, Europe now gets a different message. Their message was based on everything that happened, and now based on Monday action in Asia, you guys, in order to protect your portfolio, you need to sell 3% of your assets. Right? So it went from 2% in Asia. Now Europe gets a note, they got to sell 3%. Well, 3% starts to be a bigger number, right? Because the European markets were bigger markets than Asian markets at the time. So 3% in the European markets was a much bigger number. So European markets open at 9 o'clock in the morning. It's 3 o'clock in the morning in New York. I'm still sound asleep. Now, Asia's already traded. Monday has already come and gone in Asia. Markets are already lower. Now I wake up at 5 o'clock in the morning. I take a shower. I shave. I get dressed. I go down to the train station. I get my cup of coffee and I buy the Wall Street Journal. Okay, so think about what I just said. I'm buying the Monday version of the Wall Street Journal. What's it telling me? It's telling me what happened on Friday. It's not telling me what happened in Monday in Asia because the news didn't travel that fast, right? So I get on the train, I drink my coffee, I'm reading the newspaper. Okay, this is what happened on Friday. Yeah, okay, I know all this, blah, blah, not a big deal. Meanwhile, the world is imploding, right? Because now the European markets started to come under more pressure, right? The 3% of the European markets was a much bigger number than 2% of the Asian markets. And so European markets were starting to come unglued. So now I get to work, I get to the New York Stock Exchange 7 o'clock in the morning. I don't know anything because, again, there's no internet. There's no one telling me what's going on. I know nothing. There's no TV on the phone. There's no CNBC. There's no Fox Business. There's none of that, right? Mm-hmm. So I'm sitting in my booth and I'm organizing all my chits from Friday and doing like my usual stuff. And the phone rings at 7 o'clock in the morning. Now, when the phone rings at 7 o'clock in the morning, either somebody's dead because the phone would never ring at 7 o'clock in the morning, right? So you're either getting a phone call that somebody died or you get a phone call from a buddy of yours who just wants to shoot the shit. So in this case, it was a buddy of mine who was also a client at First Boston. He was such a great guy. I love this guy. But I pick up the phone and I said, "Hey, Johnny, what are you doing?" He goes, "Kenny, do you have any idea what's going on?" I go, "What do you mean?" He goes, "Do you know what the European markets are doing?" I go, "No," because I had no access. I had no access to the European markets on the floating exchange. I go, "No, what's going on?" He goes, "The European markets are melting down. it's going to be a bloodbath in New York today. I didn't know how to define bloodbath. I had no idea what the guy meant. Because what happened is, as the European market started to come under pressure, what did these fucking quant guys do? They now took the recent action in Europe, even though Europe was still trading, because Europe and the US trade together for 3 or 4 hours every day, right? But they started taking the data coming out of Europe, feeding it back into this supercomputer. So now when the Americans woke up and got to their office and got to their desks, anyone who bought this insurance product now gets a message that says you need to sell 5% of your portfolio. Now, why? Because of the action that happened in Asia, the markets got weaker. The action that was happening in Europe, the markets got weaker. Now in the US, we're the last market to open, because then it goes back to Asia, right? Is that the information had deteriorated so much that now the supercomputer says you guys have to sell 5%. You got to raise cash, 5% of your portfolio, and put it aside. Well, the bloodbath came. The fucking bloodbath came, right? And I'm bracing and preparing. And the next thing you know, as we get closer to 8:30, 9 o'clock, word starts permeating around. European markets are under assault. U.S. markets going to be a bloodbath. But I expect markets to have a really tough day, blah, blah, blah. Nobody could define tough at the time because no one really knew. The markets that day closed down 22.5%. We lost, at the time, the Dow was trading at 2,600. It lost 587 points, closing at 1897 or something that day, right? It was a massive, massive blowout. Now, that was the index closed down 22.5%, but individual stocks, like everything, closed down more. Johnson & Johnson, which is a massive pharmaceutical mega cap, multinational dividend-paying company, closed at $96 on Friday night. On Monday night, you know where it closed? $45. Johnson & Johnson lost 50% of its value in 6.5 hours. And it's why? Because this portfolio insurance product, this is where I say I love to tell this story, because what it tells me is people literally took the brains out of their head and put the brains over there and just did what the computer told them to do. Nobody stopped and said, wait, full stop, what the fuck is going on here? Everybody catch your breath. Nobody did that. Nobody did that. All you did was, if you were an asset manager that bought this product and you spent a lot of money buying the product, you went to the guy on the trading desk and you said, do whatever that product tells you to do. If it tells you to sell stock, sell stock. Don't question it, just sell stock. And so I was getting orders that day: sell 100,000 IBM, sell 300,000 Coca-Cola, sell 300,000, General Electric. Just sell them at the market, sell them. People screaming at us, right? And so, you'd go out there and you'd say, okay, the stock's down 5 points. You sure you still want to be selling it this aggressively down here? Screaming through the phone. Don't question me. Sell the goddamn stock. Sell it. Okay, well, that was my job. And I did as you told me to do. So, and as did every other broker, right? And so that day, the market closed down 22.5%. It was, in fact, a bloodbath that day. I mean, when I can still think about it. I still see the guys walking around the floor, guys who had spent their whole life working there, who had money invested in the market. And look, 1987, the products that exist today didn't exist then. The ETFs and contra ETFs and, buying something to go short the market. None of that shit existed, right? In order to sell stock short, you had to sell it on an uptick, right? The plus tick rule doesn't exist anymore today. And
right.
So...
And circuit breakers too, right?
Circuit breakers were born out of that event.
Because of this, yeah, exactly.
Circuit breakers were born out. So today, the market couldn't go down 22% like that in the way it did. The market the circuit breakers are 7% down from the previous night's close on the S&P. Not even the Dow anymore, the S&P, right?
Yeah.
So wherever the S&P closed today, if it closed at 4,000, tomorrow the circuit breaker, no one talks about it anymore because we don't really... I mean, it's the same thing every day, just so you know. 7% of the S&P. So if the S&P closed at 4,000, 7% of that would be, 280 points. So the S&P would have to go down 280 points. That would be 7%. And then the markets would shut down for an hour, right?
Everybody take time out.
Everybody, it's a time out. Yep. Take a chance to breathe. Let's see what the fuck is going on here. Is this an overreaction to something, or is this legitimate? Yeah. And then after an hour, the markets would reopen. They could go down another 7%, and then the market would close for 2 hours. And they give everyone a chance to breathe again. And then they'd reopen, and then at that point, they're going to let the market do whatever it's going to do. But they would give you, those circuit breakers now would give people time in the interim to go, whoa, what's going on here? In 1987, those circuit breakers didn't exist, and so therefore nothing stopped the market from going down. And look, I remember being there, and I remember Dick Grasso at the time, because he would go over to this thing called the money desk. The money desk was this location on the floor of the New York Stock Exchange where there were direct lines to the Treasury, to every major brokerage house, and the White House. And so I remember seeing Dick Grasso there on the phones, between, CEO at Merrill Lynch, a CEO at First Boston, Goldman Sachs, all these people as the guys in the industry, men and women in the industry, who were trying to figure out what the fuck is going on and what do we do. And I remember
Dick Grasso, this is the chair of the NYSE, right?
He was the president of the NYSE. Yep. And the question was, should they close the markets? Because this was out of control. The U.S. reaction was the most amplified reaction because, like I said, we were the last market to open. So what started as 2% in Asia turned to 3% in Europe, turned to 5% in the U.S. So the U.S. markets were by far the ones to get the most devastated, right? And so they talked about closing the markets, and should we close the markets? And if we do, what's the message it's sending? If we don't, what's the message it's sending, right? If they closed the markets in the middle of the day, would have been unprecedented. They'd never done that. They would have created more panic, was the thought, right? Suddenly you said, no, stop. You can't trade anymore. You can't sell stock anymore. They would have created panic versus they let it stay open. Was that going to cause more damage? I think they made the right decision to let the market stay open. I think had they closed it, it would have created more panic. But one way or the other, by the time the bell rang, it was just a bloodbath. But as I tell you this story, I can also I can feel myself on the floor at that moment as I'm telling you the story, because I can feel what I so remember what it was like. But that event then, gave birth to the circuit breakers and some other regulatory things that were put in place to prevent all that. And then we moved into the 90s, right? And the 90s was all about the tech boom and the introduction of technology and the modernization of markets. And don't forget, it was also Y2K Y2K was coming at the end of the century. At the end of the decade, it was going to be Y2K, right? And so you may not remember this because, and I say that only because there was a real sense in the world, not just the United States, in the world, that this Y2K thing was potentially going to be a huge issue because of the way Microsoft and computers were programmed. The years were formatted in 2 decimal point places, right? So 12/31/99 was December 31st, 1999, right? Well, when you went from 12/31/99 to 01/01/00, the assumption was that computers thought we were going backwards and not forwards, and that things were going to start to break. GPS systems were going to break, and planes were going to fall out of the sky, and electricity. There was no more electricity, no more water pumping. Computers were going to fail. All that shit. And so, all during the 90s, there was this massive technology boom because they had to. They were rewriting code. They were rewriting computers. They were doing all this stuff in order for the world to transition to the new century, right?
Because it's just layers and layers of stuff. Nobody knew how deep it was going to go. And you're concerned that the whole thing's going to melt down and cascade.
Exactly right. So if you were a technology investor in the 90s, oh my God, it was the greatest place in the world. Anything tech was just on fire. And so what had happened was today, you notice the date is now 2, 2, and 4. The year is always spelled out in all 4 numbers, right? So it's 2001, 2002. So the computers know the computers can tell you going forwards, not backwards, right? Anyway, one way or the other, we came into the tech boom of the 90s. It was still very open outcry. There were still human beings on the floor, 5,500 people buying and selling stock all day long. But there was also the conversation that the U.S. markets needed to be modernized. But the challenge was Y2K. And so here we were, the biggest capital markets in the world. We were not going to try to change our market structure prior to the turn of the century because our market structure was so big, we could not risk making a mistake and then having the markets fail. So we made a decision in this country that we were going to work through the turn of the century in the open outcry fashion that we did, Meanwhile, Europe and Asia had already modernized. They modernized back in the late 80s. They were already trading electronically. But in the event that technology failed at the turn of the century, the U.S. markets would have been able to continue functioning because we were still doing it by hand, open up by face to face. Europe was trading electronically, and Asia was trading electronically. So if there was a problem with technology, those two market centers would have absolutely been destroyed, right? Now, in fact, it wasn't. And the technology did not fail when we went through the turn of the century. And so once we went through and everything was good, then there was this massive push in this country to modernize the U.S. markets. And modernize the U.S. markets meant using technology now to not only deliver order flow, try to execute order flow, make it more efficient. And you know what technology does? Technology eliminates jobs, right? You can take this computer and you can replace these 4 people because this computer can do all that work. You don't need those 4 people anymore, right? And so there was a real pushback, but one way or the other, technology always wins, and it becomes more efficient and all that stuff. So at the turn of the century,
Kenny, let me pause you for just a second, just so we can summarize just what this means from an investor's perspective. So if you're in the year 1990 and you want to buy a couple of shares of Microsoft, you call your broker on the phone, right?
Correct.
And then the broker sends that trade order to some dude on behalf of that brokerage firm who consolidates and adds that to all the other Microsoft orders for that broker. They pick up the phone and call you on the floor, and then you in that open outcry market are at the Microsoft station buying thousands of shares on behalf of that entire broker, right?
Correct. But in this case, you can't use Microsoft because Microsoft was a NASDAQ name. So you have to use Coca-Cola or IBM or Johnson & Johnson. But yes, that's right. That broker would consolidate all his buy orders that day, all the sell orders, and then they'd institutionalize them, basically. They'd create one bigger order. I would then get the order. I'd go and execute it, and then you'd get allocated your shares, right? Whatever it was. 100 shares, 5 shares, 10 shares, whatever it was. But yes, it was all done by hand.
So,
you could not do it. You couldn't access the markets directly. You could not.
Right. And at that time, the New York Stock Exchange controlled the biggest portion of stock trading volume, right?
Well,
because Microsoft trades electronically on the NASDAQ, but most of it is the open outcry market through the NYSE. Is that right?
Right. The New York Stock Exchange, there were essentially 2 marketplaces. There was the New York Stock Exchange and there was NASDAQ. That was it, right? So anything that traded, any listed company, and I say listed meaning listed on the New York Stock Exchange versus listed on the NASDAQ, right? But anything that trades, and you know all the names, right? They're the big names that you would think of. IBM, Johnson & Johnson, General Electric, Bank of America, American Telephone, Verizon, they all trade on the New York. When you think about NASDAQ, you think about small cap names, technology names, Microsoft, which no longer is small cap, but that's where they started. When Microsoft first started, it didn't meet the listing requirements of the New York Stock Exchange, number 1. And so therefore it was not able to trade on the New York Stock Exchange. So it would trade on NASDAQ. And NASDAQ was an exchange created specifically for that purpose. It was a marketplace that was created for small caps, startup companies that needed to raise capital. Back in the 70s. And so,
are commissions fixed at this point? Still, when did
commissions became unfixed in I want to say 78, 79, because there used to be fixed commissions. So but depending on the price of the stock, you paid $10, $20, whatever it was. They were fixed commissions based on the price of the stock, the number of shares, all that stuff. Today, when they deregulated commissions or unfixed them, whatever. Then it was just cents per share, no matter what you did. If you bought a $100 stock, it was the same as buying a $10 stock. It was just cents per share, right?
And the only reason the only reason I bring that up right now is because when commissions went from fixed to floating and market based, right? Then you have new competitors enter this trading market, like Charles Schwab, using computers to trade.
Well, at the
with
time
more technology and push the modernization, right?
Yes, but at the time when they deregulated commissions back in '78, it opened up competition, but it wasn't with technology yet. The technology didn't exist, but it did open up competition. So to Charles Schwab, whatever, right? So because then you were able to compete on price. So that was the first part. The technology part came as technology started to make huge advancements in the 90s. But remember what I said. They were not converting the New York Stock Exchange. They were not converting the capital markets to technology-based markets until we went through the turn of the century. Now, that doesn't mean that all during the 90s, there was this whole group of people working behind the scenes to rewrite the rule set, because the rule set that existed to govern an open outcry market trading in eights was very different than the rule set needed to govern a market that's now electronic, trading in decimals and then subdecimals.
Right.
So you had to rewrite rules. You had to rewrite order flow rules. You had to rewrite, they eliminated the short sale rule. All that stuff had to be, and then once you eliminate all those rules, then you have to write computer programs that can now respond to these new rules, right? And that was all happening during the 90s. It was kind of happening on the back burner, right? Because we were still trading open outcry all through the 90s. And so when we went through the turn of the century and everything did not fail, then the push to modernize really happened. And so we started probably in February of 2000, and they started to convert. And they had to convert them from fractional trading to decimalized trading, right? And so remember, decimalized trading and fractional trading, there were only 8 price points, right? We traded in eighths of a dollar. So it was only seven prices that you could use. So it was an eighth, a quarter, 3 8 5 0 7 8. That was it. Between every full figure, there was 7 different price points. Each price point was 12.5 cents. So if you went into a crowd and the market was a quarter bit off and at a half, and you were a buyer and you were going to pay up 25 cents, you were going to take stock at half, you better be damn sure you understood what you were doing, how much you were buying, what other people in the crowd were doing, what your customer wanted to do. There was so much to think about when you were executing, right?
Right.
In a decimalized environment, now there's 100 price points to trade. Between every full figure, it's a penny, 2 pennies, 3 pennies, 4 pennies, all the way up to 99 cents, right? And so the computers, it became more fluid. And now we trade in subdecimals. So now there's 1,000 price points to trade at. Between $20 there's 0.0001, 0002, all the way up to 9999, right?
Yeah, right.
But that so we can get to that. But that happened after we completely converted from fractions to decimals, and that took about 6 months, because they as they converted. You couldn't just take every stock on Monday that traded in fractions and then just make everything trade in decimals the next day, because no one knew if the system was going to be able to handle it. No one understood, what it really meant for quotes and people sending an order flow and all that stuff. So they did it over a period of 6 months. So they did stocks A through D, and they converted those from fractions to decimals. They let those trade for 2 or 3 weeks. Okay, everything's okay, great. Now we're going to do stocks E through H, and they let those stocks trade in decimals. So it took 6 months to go through the whole alphabet, get everything to trade into decimals. Once everything was trading in decimals, then they handed you this thing that looks, well, today it looks like an iPad. Then it did not look like an iPad, but it was about the size of, it was about the size of
your garage.
Yeah. I mean, when you think about it, the size of a computer screen, right? Not bigger than an iPad. It was also thicker, right? It was like this thick. And it had a battery that lasted 45 minutes. Oh my God, that was like a huge breakthrough. Wow, this battery can last for 45 minutes. Now you laugh because battery lasts for 45 minutes is useless, right? But then it was a major breakthrough. And the battery was also connected by a wire, because the battery was also this big thing. And it was connected by a wire and had its own pouch, and you put the pouch on your belt. And because it was that big, right? And that would power the handheld computer that you were using. But you had to be very cautious, because the battery only lasted 45 minutes. So if you went 45 minutes and you weren't paying attention, your battery died, you lost all your information, right? So people were constantly running back and forth, like it's a pit stop. If you go to a NASCAR race or you go to Formula One, when the guys pull in and they change the tires really quick, and then the car runs out. So you would run over to this place where they change your battery. They'd plug you into a power source. They'd take the old battery out, they put new battery in, and you're off the races again, right? And it was constant. It was unbelievable. It was so funny when I think about it now, because now it's so much different. Now it's like an iPad, and it's really thin, and the technology is so much better. The handheld, the touch technology is so much better.
And it's quiet on the floor.
And
people are leisurely walking around, strolling at their own pace.
There's no more 5,500 people. They're all gone. What used to be 5,500 people is less than 150 people today that does all this trading. But remember, all the trading no longer takes place at the New York Stock Exchange. 100% of it doesn't. The exchange trades about 20% of the total volume, right? Everything else is split amongst, the other 11 exchanges that exist today, plus the 40 or 50 different alternative venues, which are not exchanges. They are trading venues owned by the big banks and brokerages. They're internalization engines, but they do trade. They trade stocks. And that was also born out of the events of 9/11, which we didn't get to yet, because what you also need to understand is what happened to the markets and why we have what we have today is because of those events of 9/11 and what the threat that it brought to the country, the threat that it brought to the system, and the threat that it brought to the U.S. financial as well as the global financial markets. And what had happened when 9/11 happened, we had just converted from, over the year 2000, we converted all the decimalization. We introduced all this handheld technology. We started to trade electronically, right? It was slow. There were still brokers, doing it out loud because the technology wasn't perfect yet. So it was kind of a hybrid, right? With the broker and the technology and all that stuff. And what people need to understand, and here's the part that's really fascinating for people when they hear it, is that all the technology, all the cables and wires that ran the technology at the New York Stock Exchange, the fiber optic cables, the T1 lines that, connected the outside world into the New York Stock Exchange and all the servers, they all ran through the conduit that went through the belly of the Trade Center, out underneath the Hudson River, and then out to the rest of the country, to Chicago, Philly, California, Boston, whatever, right? And so when 9/11 happened and those buildings collapsed, all the conduit, all the cables that existed in the belly of the Trade Center all get severed and destroyed. And so now the New York Stock Exchange, while the building itself was fine, the guts of the New York Stock Exchange now didn't work anymore because the connectivity was gone. There was no more, right? All those cables were all severed. So therefore there was no information going back and forth. So what the country doesn't realize, the majority of the country didn't realize, maybe doesn't even now, is that the markets didn't open on Tuesday clearly because of the event, but they didn't open on Wednesday, Thursday, or Friday because they couldn't open. The markets did not function. Yeah, you could turn the lights on to the New York Stock Exchange. You could turn the computer on, but there was no information flow. The computers had no one to talk to because the lines were severed, right? And so we recognized that immediately. We, meaning the industry, recognized that immediately. And so we realized that the New York Stock Exchange, after this event, that the New York Stock Exchange, even though the building itself wasn't damaged, but the New York Stock Exchange was out of business because now we're trading completely electronically.
Yeah.
We got rid of the open outcry. That was gone. And so now we were trading completely electronically. And now the U.S. capital markets didn't work because because of this event and the destruction of the towers, all those cables and wires got severed. And so now we had a problem, right? And so we recognized this right away. And so we brought guys in immediately from around the country, cable guys and phone guys and all that stuff, because they had to rewire all the servers and all the phones and everything at the New York Stock Exchange back to the outside world, all while this event at the World Trade Center is happening, right?
Yeah. And
it was
quick
an amazing moment in time.
Quick side note, there are so many great case studies in stellar leadership throughout 9/11 and all this. But think about if you're in the role of deciding how to communicate what's going on with the stock exchange in this setting, right? You can't even open if you wanted to. So what do you communicate and how so that you don't induce panic into the markets? And as I remember, I think the Fed had a statement that was succinct and very well written that said something like, "We will remain open and provide ample liquidity when needed," or something like that.
Which they did.
Which they did. And I mean, I was in high school when this happened and didn't fully appreciate it at the time, but it sounds like it was handled just superbly across the board.
Well, it was.
What's your take on it?
And in fact, the Fed cut rates, right?
Yeah.
Because there was all this panic. So the Fed cut rates, they provided enough liquidity to the markets so that the markets needed to, when the markets opened on the Monday, because you have to remember, the markets, they traded on Monday the 10th, on Tuesday the 11th until Monday the 17th. The markets didn't open. The markets didn't trade. And so now there's this building panic around the world because people couldn't sell their stocks. And, on Monday, you had an account that was worth $2 million. And on Tuesday, this event happens. You can't sell your stocks. Wednesday, you call up your broker. You say, you know what? I'm a little bit nervous here. I want to sell my stocks. The broker says you can't. And then on Thursday, you call your broker and say, okay, I want to sell my stocks. Broker says you can't. And so
Yeah.
now you're thinking there's this panic setting in. And now your $2 million account is, you don't know what it's going to be worth when the market's open. Because because what was expected to happen was there was going to be this onslaught of this wave of sell orders that were coming because people didn't know what to expect. They didn't know what was happening. And so it was potentially a problem. And when the markets opened on the Monday the 17th, it was exactly that happened. Markets sold off big. They came under immediate pressure. I think they closed down 500 points or something, which was in 2001, 500 points was a big move.
Yeah.
But the Fed came out. The Fed provided enough liquidity. The Fed, they cut rates, if I remember correctly. They provided liquidity because they didn't want the markets to panic. They didn't want, the run on the bank. They didn't want that whole scene to play out. And in fact, it didn't. I will say they did a great job. But the market remained very skittish for a while after that event because that event was that was such an enormous event in terms of the history of the country and the capital markets and what it meant that the markets remained volatile for 2 or 3 months after.
Yeah, it was so jarring for sure.
Until it was sure that we had control once again and that the U.S. capital markets were safe, right? But it was that event that then gave birth. That event gave birth to the market we have today, which is completely automated. There are now 11 exchanges that exist. There are 40 or 50 different alternative venues, which are also connected via the computers that are not exchanges. They're venues. They're internalization engines owned by the big banks and brokers. So you can buy and sell Coca-Cola on 60 different places if you want, right? So all trading at the same price.
Yeah.
Within millions of a penny, right? Not like thousands of a penny. It might be trading in New York at $50.10, and it might be trading in an alternative venue at $50 spot 0.009999. You know what I'm saying to you? But it's relative. It's trading. It's not trading at such disparate prices that you can buy it on this exchange at $50 and sell it at this exchange at $52. That's not happening, right?
Right. And one concern I think people have from time to time is they recognize that there are all these different trading pools that exist these days, and there are hedge funds kind of sitting behind the scenes paying for order flow that they make money off of, and they're concerned that they might not get the best execution on their trades. But because the other side of that is because it's so easy to trade, there are so many entities across the market that are arbitraging those little sub-penny movements. That the difference, I mean, personally, I'm probably never going to trade more than 10,000 shares of any stock from my own account in my whole life, right?
Right.
And so what is 0.00001 to me? It's a couple of pennies, even on a massive size trade.
Correct.
Right?
Correct. But when we went to decimalization, we went to 2 decimal places. That was the move. And then when the 9/11 happened, and then these alternative venues showed up, and market structure started to change, and all the wholesalers and all the liquidity providers like Citadel and Fidelity and all those places lobbied the SEC and the industry hard. They said, listen, in order for them to be able to compete and have liquidity in the system, we needed to trade in 4 decimal places. There needed to be more choice in order for them to participate and trade and help stabilize the markets and all that stuff. I thought the argument was bullshit. I still think the argument's bullshit. But one way or the other, the SEC caved, and so now we trade in sub-decimals. But they only trade in sub-decimals in the alternative venues. The exchanges, like New York and NASDAQ, still trade in only 2 decimal places. So if you see something trade at 50 spot 1, 2, 3, 4, you know that it traded on an alternative venue, not one of the exchanges. If it trades at 50 spot 12 or 50 spot 22, chances are it traded on an exchange, right?
Right.
That's how you can tell whether or not you actually bought the stock on an exchange or bought the stock in an alternative venue, depending on the price you get. It'll give you some indication. But one way or the other, the events of 9/11 then gave birth to what we have today, which is now a marketplace that's defined by 11 exchanges and 40 different alternative venues. Everything's run electronically. The New York Stock Exchange is the only physical exchange that exists. Everything else is virtual. It trades in the cloud. The servers are located all over the country that run those venues. Because if the servers are all located in downtown Manhattan, all somebody has to do is bomb downtown Manhattan, and you bring the place to its knees again, right? Now, if they blow up the New York Stock Exchange, is it a problem? It absolutely is a problem in the sense that it would be a tragedy, but it will no longer bring the system to its knees, right? The system will function without the New York Stock Exchange. And that was proven during COVID when the exchange actually closed for 8 weeks because of COVID.
Yeah.
You would never have noticed that. Trading still happened every day. Stocks still traded because they traded electronically in the cloud in these virtual marketplaces, right?
Right.
And so that's the structure we have today. And it's all driven by technology and algorithms. They've taken the human being out of the picture. And that's what it is. Listen, we're gonna have to have a follow up because we're over an hour now, and I gotta go.
But, I want to be respectful. I've got a ton more questions for you, but I want to be respectful of your time. Maybe sometime down the road we can have you back on because this has been great for me. I mean, the history lesson, the experience that you have on the floor is just always enlightening for me to hear, and I really appreciate you sharing it with us today.
Well, listen, I've got a lot more to talk about, and I'm happy to do this again with you to kind of talk about where we went from, 2001 to today and everything that's happened since, not only in terms of the markets, but technology and trading and systems, and then where we are from an economic viewpoint, right? The Fed, monetary policy, interest rates, unemployment, inflation.
Oh, yeah.
Because there's a lot to talk about.
Yeah. So you write a lot of market commentary daily. Where can people get a hold of that?
So I write this daily note that you can go to my website and subscribe to it. It's free. So just go to my blog site, which is Kace Capital Advisors, but it's KACE capitaladvisors.com. And then just click on the blog tab, and then you can subscribe to it. Just put your email address in, and you can subscribe to it. I also then turn that into a video, so you can go to my YouTube channel, and if you don't want to read it, you can listen to me talk. And I recreate that in video format.
It's more fun
YouTube
to watch
channel.
And listen to you talk, Kenny.
Yeah. So if you go to YouTube and go to Kenny Polcari Media, it'll take you to my YouTube channel where you'll be able to see that. You can always catch me. I do a lot of market commentary. You can catch me on Fox Business. You can catch me on CNBC. But there you go. And you can catch me on Twitter, right? My Twitter handle's @Kenny Polcari. Everything I write, and like the videos appear on my Twitter. The note appears on my Twitter. It also appears on my LinkedIn too. So you can get it in a lot of places.
Right on. Well, thanks again, Kenny. This has been great. And I look forward to chatting with you down the road here too.
All right. Take good care.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.